All right, so continuing with the second video here, we're going to look at the fact pattern in a little more detail, the actual numbers, and then we're going to see how these end up on the 1065. So if we start with the financial statements, you just walk through these really quickly. So remember, this is an investment fund set up in the U.S. It's a Delaware entity, and it opened a brokerage account with a U.S. broker, and then it opened a brokerage account with a Swiss broker. So it went to Credit Suisse or UBS or whoever it might be over there in Switzerland, open a brokerage account, and so it's trading Swiss stocks through its Swiss broker, and it's trading U.S.-based stocks and securities through those U.S. exchanges. So when we do the financial statements, we try to be as detailed as possible in separating out what's U.S. versus what's Swiss source income. So these are the balances at the end of the year in the accounts. So we have a savings account in the U.S., a Swiss account. All of this is expressed in U.S. dollars, where we've translated it to U.S. dollars. These are the U.S. stocks at cost. That's the balance. The Swiss stocks at cost. So obviously these are after purchases and sales. The capital contributions there, that was the amount of capital contributed to the fund, $3.25 million, and that's the amount that we can see here on the cap schedule, right? So $3.25 million was put in. Capital distributions, we'll look at that a little more closely. That's the amount of cash distributed from the fund to the partners. And then the net income on the balance sheet is obviously pulling from the P&L over here, right? We have our U.S. interest income, Swiss interest income, U.S. and Swiss dividends. These are just ordinary dividends. And then the short-term capital gains and losses incurred during the year. So the net gains on the U.S. stocks, net gains on the Swiss stocks, and then we'll show how all that is ultimately reported on the return. Now, the expenses, we did touch on this earlier too, right? The investment management fees, the portfolio management fees paid to that portfolio advisor, management company, and then the foreign taxes paid. So the taxes paid here, the Swiss withholding, remember, the fund didn't actually write a check for these, right? When there's withholding taxes, you have to report the gross amount of dividends and then report also the gross amount of withholding that came off the top. So in other words, this is the gross amount of dividend income that was paid by those Swiss brokers into the account, but not the net, right? The net was likely the difference here, right? So it would have been like $17,808 actually got deposited into the account, but that's because they were supposed to get $20,950, and then there was $31.42 in withholding taxes being deducted before it was even deposited. All right. So if we want to make sure we're taking care to account for the foreign tax credits, we have to report the gross amount of the dividends and then the gross amount of the foreign taxes that were withheld. Okay. Okay. So let us look at a slide here. Just want to touch on these dividend sourcing issues again. Okay, so I'll keep coming back and referencing this when we go through the return. So we've got our dividends there, and all of these items are being allocated per the ownership percentage of each partner relative to how much capital they put in. So in other words, John put in $500,000, and the total amount of capital contributed at the time was $3.25 million. So if you divide $500K by the total, we get 15.39%. And the same goes for all the other owners here. So the greater amount of capital you put in, the more income allocated to you. Makes sense, right? So we use these ownership percentages to figure out, okay, of the total interest income, total U.S. dividends, total foreign dividends, allocate a certain amount to each person based on that ownership percentage, right? And so we just go on down the board with all these items. So we've got the U.S. and foreign dividends, the capital gains being allocated. There's the investment management fees being allocated to each person, the amount of foreign taxes withheld from the Swiss entity, or the Swiss entities rather, those Swiss withholding taxes. We'll see this is the total amount of book income being allocated. And then the distributions to each partner, remember, was going to be 10% of the book income allocated to each partner during the year. So that's 10% of $50,754, right, and so on. Now, the U.S. taxes withheld, notice how this differs for John and Jane and the other partners. So John and Jane are U.S. citizens, and so for that reason, we don't have to withhold any U.S. taxes on their allocation of U.S. dividends to them. But we do for Ben and the Cayman Fund. So the Ben claims that reduced treaty rate. So if we look at the U.S. dividends allocated to Ben, $18,985. If I get out the calculator here and do a little math, 985 times 15%, he's claiming the 15% withholding rate. So we're going to withhold U.S. taxes and pay that to the IRS of $28.47. Right, or round up, so $28.48. Same goes for the feeder fund, right? The feeder fund is subject to the 30% withholding rate in Cayman because Cayman doesn't have a tax treaty. So of the U.S. dividends being allocated to the Cayman Fund, $37,985, we got 30% times that gives us the $11,396 U.S. tax liability. Now, once everything is said and done and allocated, these will be the ending capital numbers for each party, and we'll see these reconcile with the figures on the K-1. Okay, so now if we jump into the 1065 and start kind of going back and forth between this and then the financials, and you'll start to see kind of how these numbers flow through the 1065 and the K-1s, and then the third video, we'll actually look at the K-2. So this is page 1 of the 1065, just information on the fund up here. You'll notice page 1 is basically blank on these income and deduction numbers, and that makes sense, right? Because this is an investment fund. It is not conducting any ordinary trade or business, so we don't have ordinary trade or business income. This is consistent with what you would see in a lot of private equity funds, investment club funds, hedge funds. Page 1 isn't going to have much. Now, we do have to complete Schedule B. So we've indicated up here it is a domestic LP. All of these are no answers given the type of question. We do have an interest in foreign bank accounts, right? So we have a Swiss bank account here, so we will do a FinCEN Form 114 to report that account. Schedule B, other information continued. Still some no's there. We don't have any basis adjustments, nothing like that. On question 14, we do answer yes, right? We answer yes if the partnership has any foreign partners. We do. We have 2 foreign partners. We have a Cayman entity and then Ben Church, who's a German tax resident. But we are not filling out any 8805s. So 8805 and 8804 would be required if this entity was engaged in a trade or business in the U.S. and had ECI, or otherwise had ECI flowing to it from other underlying investments. We don't have any ECI. We do have withholding. We do have Chapter 3 withholding on U.S. source dividends being allocated, but that's where the 1042s come in. And so that is question 19 down here, right? So during the year, did the partnership make any payments that would have required to file 1042s? The answer is yes. Right, we have Chapter 3 withholding here on U.S. source dividends allocated to non-residents. That's this issue here. Right, Ben Church and the Cayman Feeder Fund, they are subject to U.S. withholding taxes on their U.S. source dividends. And so these are the U.S. Withholding amounts that we're going to have to basically garnish from their distributions and pay that to the IRS as the taxes. Okay, the remaining questions are no. And okay, so Schedule K, this is where we start to enter some of the information from the financial statement. So what's important to remember about Schedule K, and this has been the case for years, is you'll notice here there is no distinction between source of the income. In other words, we look at line 5, we see interest income, we report the total there, but nowhere here does it allow us to say whether it's U.S. or foreign source interest. That's where K-2 and K-3 come in. So with K-2 and K-3, we are now able to tell not only the IRS, but the user of the K-1, hey, if you're allocated interest income from this fund, what portion is U.S., what's foreign, and if foreign, from what country, right? So a lot more information is being provided. So the total amount of interest for the fund Let's go back to the financial statement. So these total here, 1625 if we add those two together. So that's being reported there. The amount of dividend income, 103,250, is being reported on the K1. So that's the 82,300 plus the 2950. That's the 103,250 there. And then the same thing for the capital gains, right? So capital gains are being separately reported on 8949 in Schedule D, but that's the total amount that's being run through this partnership entity. Now, I don't have the worksheet here, but you do have to break out the portion that's qualified, right? So the total amount of ordinary dividend is reported here, and then the qualified portion is indicated here on 6B. So this is the amount of qualified dividend usually isn't reflected on the financial statements you would prepare here. What you would do is wait for your broker to provide you the consolidated 1099, where it would break out, okay, 82,300 in ordinary dividends. Of that amount, X dollars is qualified. And you could do the same thing with the Swiss stocks. Generally speaking, foreign companies that pay dividends to you are not qualified unless they are under a treaty. Because the U.S. and Switzerland have a treaty, you can get qualified dividend income from foreign dividends. And so that's what the fund's done here. And so what the fund has done is it has allocated within the U.S. and the foreign dividends, what portion is foreign qualified, what portion is U.S. qualified, and so we have that listed on the K1s as well. All right, so the deductions there on line 13D, the $32,500, that's the portfolio management fees, the 2% AGI type deductions. Again, not deductible for federal purposes really anymore, but still relevant for some states, and then perhaps in some international contexts. Then on line 19A, we have the distributions. And then on line 21, we have the total foreign taxes paid during the year. All right, so now if we look at Schedule L, again, just a simple balance sheet, very, very straightforward, matches what we have on the financial statements. Total amounts of cash, the investments at cost, and then the total ending capital for the group. So 3546810, that does reconcile with our capital roll forward schedule. So if we look here, we can see that, okay, 3546810, the total amount of capital for all the partners is going to match that number. So things do look pretty good here so far. So we've got the net income or loss per books, 329,791. That number again, we can see that on the financial statements, 329,791. So the total income minus the expenses minus the Swiss withholding tax. And then M2, right? So we'll roll forward to the capital accounts. 3.25 in cash was committed. That's the net income or loss per books minus the distributions. There's our ending capital number. All right, so now the sale of the stocks reported on Schedule D in 8949. All of it was short term. We didn't have any long term buys or holds. So when we look at the 8949 here, we're just grouping the sale of securities for each. So we've indicated various on the sale dates, total proceeds, code M, indicating we're reporting multiple transactions on one line item. Obviously, you can print out all the detail if you want, but you are provided some latitude with grouping these. And then it's Part 1, Code A, so short-term transactions with basis being reported to the IRS. Now, for the foreign dispositions, we're reporting these as basis not only not reported, but not reported on 1099B. And that also kind of makes sense, right? Think about this. This is stock that's being traded in a foreign brokerage account. They do not provide 1099s to the IRS because they're not legally required to. So we don't have, not only do we not have basis information submitted to the IRS, but we don't have any information submitted whatsoever. So we use whatever materials the broker provides us, we use that to complete our 8949 and Schedule D, okay? And then on this is an overflow statement that we've just attached. So it separates the interest dividends by source, so U.S. versus foreign, so you can trace the totals to Schedule K, right? So not required, but We like to include it anyway. And then here, it's simply just a capital roll forward, right? Each taxpayer, or each partner rather, the beginning capital is 0, obviously, the amount of capital put in during the year, and then a roll forward of the net income allocation and withdrawals. Okay? All right, so for the next video, we'll jump into the schedule K-2.